me tonight. I did want to talk first about how what I just sent out. So we just sent out the presentation here, and oftentimes it's better to kind of go through these things from the standpoint of me explaining them, because there's so many charts and graphs, and economists were, it's the dismal science. I was actually telling Bruce this earlier this week. It's the dismal science because it's not like physics. If I pick up my calculator here and I throw the calculator across the room, I know what it's going to do. I know how physics is going to act on it. And economics is not like that, because it's a human science, which is what I find so interesting and fascinating about it. Is that it's not predictable. How you and I feel today can change very quickly tomorrow, and we can very quickly tighten up on our spending. We can tighten up on businesses can do the same thing too. Businesses can decide that they do not want to be investing capital or investing in new people and hiring people. It's been a brutal year this year. It's, as you can see, across the board, even bonds. This is the worst year since the Great Depression. So it's been horrific. And not as bad. It hasn't been as bad from the stock market standpoint as the tech bubble of 2000 during my 25-year career here, since I've been managing money. And some of you have been clients that long, and thank you. And it hasn't been as bad as the financial crisis. But you can see for a balanced portfolio, this is the worst. You have to go back to get worse years. You have to go back to 1931 and 1937 to have worse years, and really almost worse than 1937. So this has been a terrible, terrible year. The good news for us at Altrius is, we're down about 11% after today's rally, maybe 10. And that's not, it doesn't feel good to be down 10%, even though the market's down, 25, and the NASDAQ and the stupid stocks that we'll never buy for you are down much worse, like Netflix down 60%, and Facebook down 60+%, and, Snap, companies like that down horrifically 80% this year. Those are not the types of companies that I buy for you. The good news for us too is that although we're down from a portfolio value, and I get paid based on your portfolio value, so I often kid that your income hasn't changed at all. In fact, it's gone up 10% from last year. So it's kind of important to remember, if you had $1 million and today it's down to 900,000, we're basically back to where we were at the beginning of 2021. Everything we made last year has been wiped out this year. But most importantly, as you see from these green triangles here, this is always the most important thing. I kind of say, if you remember one slide, remember this one. This isn't our first time we've been through horrific sell-offs for our clients. But the green triangles have always been there for you to fund your retirements. So as long as, Procter & Gamble and Pepsi, which reported, Procter & Gamble reported this week, Pepsi last week, keep paying their dividends, which they are. In fact, they've been raising them for 25+ years. Then you're going to be fine. And I never have to sell a share of stock for you. Becky, who's doing most of our trading, and we don't have to sell those shares to get you the income you need. It's always been there for you. And I think that's an important thing to think about and remember when you're worried about the market valuations. And that's true too. You can see here from this, if you took out 4% a year, now you should be worried if you're taking out more than 4% a year, right? So that's where most of our clients are taking out about 5.5% to 6%. So they're taking out a little bit more, some on average, and that's where, when the market is down and we're forced sellers, then that's when your portfolio can start eroding principal value. And so that's something for you to, I'm never going to tell you, hey, you can't take the money out. It's your money. But most importantly, we'll just give you probabilities so that when our advisors are working with you, and by the way, just to kind of, show you our team here, we've got a neat little calculator that we put together, which I think is really kind of nice for you to go into the tools calculator, and you can kind of get a little probability of success. And you say, okay, I've got, $1 million, and I'm 65 years old and I want to live 35 years for joint life expectancy. And you do a calculation and the calculator says, well, you can take out $3,000 a month with an 80% probability. These are just probabilities of success, right? So if you want to take out more, we're just going to tell you, okay, no problem. Your probability of success obviously goes down. But the nice thing with Altrius is you're never investing in hope. We're not taking it and chucking it in some crazy stock or worse, like a Bitcoin, which is down 60% this year, and hoping it goes up. We're investing in real companies that pay you real dividends, and that's this income stream, which is there for you. I mean, you talked to a couple of clients today, and I said, yeah, you're like the email I sent out earlier this year, your income is up 10% from where it was last year. Meaning, if you had $1 million portfolio pushing out $40,000 last year, this year is pushing out $44,000. So the companies we're investing in have continued to increase their dividends, as long as you're reinvesting those. If you're not, though, that's fine too, because then you're just taking the income out and using that to fund your retirement income needs. So this is where you want to kind of dig down with your advisors, and you can do that at any time. Just call us, and we've got the e-money software, which we spend a lot on. The quarterly reports that we send out, that's the $130,000, $40,000 a year system that shows you exactly how you're doing year to date. That's very sophisticated. But we also have the e-money, which is available to you, which gives you a general idea of how you're doing, and some general planning guidelines, which is really nice too. So at any time on the planning side, the wealth management side, don't hesitate to call us or your lead advisor, and just to kind of introduce you to the team too, and what everybody's doing, because we continue to grow. Ralph is working in Florida. He's our new compliance officer and chief operating officer. Of course, Annie, some of you worked with Annie, my wife, who's our chief financial advisor and a financial advisor. So we have 4 financial advisors. Greg is lawyer trained, nice guy for a lawyer, and he's forgotten more about real estate and private real estate than I've ever known. So if you have sophisticated real estate needs, Greg's great to get involved. Max works with a lot of our clients. He's in Savannah, Georgia, and it's very good on the planning side. And of course, Chris, who's been with us for 7 years, working out of a Raleigh office, is very good at planning and taxation. And his dad's actually a lawyer, estate planning too. So who I'm having lunch. So we have plenty of experts where we ever need more expert knowledge. In fact, Fred was helpful with my book on the estate planning side and kind of proofreading it for me, which was very helpful. I'm going to have lunch with him in Michigan on Tuesday. So I'm looking forward to that. Of course, Zach is Zach's been with me for over a decade, is making all the fixed income decisions. So he thinks exactly like I do, and he's done a terrific job over the last 3 years. He makes the final decision now on all of the fixed income side of the portfolio. Zach lives in Austin, Texas. Becky's doing the majority of the trading in your portfolio. When I say, okay, we're going to sell this or buy that, that's Becky doing that, or getting your cash flow needs. Anu works in Connecticut. She's an excellent analyst who helps me with all of the equity decisions. Joy works in supporting Chris out of our Raleigh office. Of course, many of you know Rita. When you call in often, it's either Lauren or Rita who are usually answering the phones. Rita's been with me almost since the beginning, and supports Greg and I, and Lauren supports Max. So on the operations side, we really have a great team. I just wanted to make sure that you kind of knew what everybody else was doing behind the scenes, because you don't often talk to some of the people who are on the screen. And then, of course, from the standpoint of your income, the worries right now, and this happened during COVID, our income actually went up during COVID. We went through this horrific 30% stock market decline. We weren't down, that much, but we went down too. We slid a good 20%, but we recovered very quickly. And now we're kind of sliding down again. And what often happens is you kind of get grounded, right, from your portfolio, is that people start getting upset. They're like, they lock in on the value, wherever that portfolio value is. So it might be right here, and you forget that, we've done really well over the last, 5 years. And so you lock it in that new number. And when it goes down even a little bit, you're still up a lot over the trailing, over the trailing 5-10 years that you've been with us. But it still doesn't feel good when that portfolio value goes down from, in this case, let's say this is a real client here, 4 million down to 3.6 million, you're down 10%. And you're like, oh my God, I'm down 10%. When you kind of pull back a little bit, you realize, oh, wait a minute, we're still up pretty nicely over longer periods of time. So sometimes it's important to kind of unground yourself from that recency bias with things, just going down here this year, and take that longer. I mean, you've been with me, many of you have been with us for, decades, and this is how we've done. We've done, $1 million has grown very nicely. And those of you who started with $1 million and have taken income out, you still have more than $1 million if you've taken out 4% a year. So again, I think this is a testament to our boring strategy. We've been through tech bubble, wars, real estate bubbles, financial crisis, European crisis, oil sell-offs, COVID, and now, the Russian invasion and inflation. That'll be on our slide. In fact, Max, we should put this on our slide next quarter when we update our slides. Put inflation in here is obviously one of the main things we're fighting against right now. We'll have to slide that COVID crisis over a little bit and put inflation in here. From the standpoint of the large companies, the market is down a lot worse than we are, because I've avoided these stocks. We have not invested in the crazy tech stocks and gotten on that crazy train, or what I call clown companies, even worse, companies that don't even have earnings, right? Companies that have revenue growth, but they're spending more than they're making. We're never going to invest in those kind of companies. And all 74 of our companies that you and I own, and I own the same companies that you own. I'm invested side by side. You and all of our Altrius associates are invested side by side, our clients, in the same stocks and bonds that you are. The market cap of these is actually less than just these handful of stocks. And I mentioned this on Fox Business like 2 years ago before COVID. And I told the anchor, I said, do you realize that 17% of the S&P 500 consists of just these handful of stocks? And during the break, she said to me, she's like, are you sure? I said, yeah, I'm positive. And that 17% actually grew to 25%. It's now back down to 23%. Now, we'll own these companies if they're cheap enough and if they pay you a dividend. We owned Apple when everybody hated it. And, my neighbor, Jim Cramer here in Summit, was talking about how Apple doesn't have any new products. And, I didn't care. They had a tremendous cash flow. And, of course, Apple just exploded. Same thing with Microsoft. For years, we owned Microsoft. And what you saw with Microsoft is that the stock was really, it just beat up. And I was showing this to our team, investment team. I was bringing up the fact that Cisco has still not reached its peak when you go all the way back to 2000. If I brought this chart and I brought it back to 1/1/2000, what you'll recognize is that paying too much for companies. I mean, look at Cisco. It hit its height of $77 back in 2000 in March. And look at it today. We own it today. It's still only worth $45. So paying too much is always a bad strategy. And I'm never going to pay too much. Max and Greg here, my institutional pitch, when we sell to financial advisors and sell to the teachers union in Chicago or other institutions across the country, I always tell them, listen, if we didn't chase hot performance or chase that hot dot, or jump off the Brooklyn Bridge with everybody else when these stocks were just going, we're certainly not going to do it now. And you can see back then there's no D's next to Cisco and Microsoft's name. And we bought Cisco and we bought Microsoft in here when they started paying a dividend. See these D's, and they've continually increased their dividends. But then when Microsoft just shot through the moon, at that point, it makes no sense for us to be owning Microsoft anymore. And we're usually in early and out early. And that's effectively what we do at Microsoft. Same thing with Apple. We got into Apple and then out of Apple last year after it just zorched to the moon. And that's, and you can see what's happened here. If I just do a 2-year chart, I mean, look what's happened to Microsoft. It's kind of come all the way down. And that's, we want to, we don't want to, again, if we look at some stocks like Facebook, which have just been decimated, when they're going up, everybody talks about them. Like, Jim, how come you don't own Facebook? Because look at Facebook was up here. And I said, we're not going to own something that I have to pay 100 times earnings for that's not paying you a dividend, because we have to hope it goes from the $376 I'm paying for it here. We have to hope it goes up to fund your retirements. And again, at Altrius, we're not investing in hope. And of course, we see what's happened here. It's just absolutely, collapsed in the last 2 years and been decimated. Year to date, Facebook is down 60%. And I'm sure all of you are thankful that we're not invested in those kind of companies. So avoiding, sometimes what you don't invest in is more important than what you invest in. And avoiding these highly, which for a while it looks like, oh, how come you're not investing in these stocks? Well, what happens is the bottom often falls out. And that's what's happened to them. So we're going to continue to avoid those stocks, because investing in the things that were the largest, you can see this back in 1980, IBM and AT&T and Exxon were the largest companies on the planet. And today they're not even close, right? They're not even in the top 10. And look at 1999. Remember that company called Lucent Technologies or America Online? You've got mail. Who's doing that anymore, right? These companies don't exist anymore. Investing in always the largest company is generally not a good idea. And you can see that doing so has really cost investors by chasing the uber large companies. So we're usually not invested in those types of companies. Now, the big question that everybody asks me is, Jim, where are we going from here? And I'm an honest economist. So my answer is, I have no idea. There are two camps for economists or pundits or all the idiots that you see on TV. Camp one says, I know what's going to happen, and this is what we're doing. We're going to cash for our clients, or we're going all in, or we're going to do this, or we're going to do that. Those people are either liars or they're idiots. They think they can divine. I mean, who would have thought that? Think about this year. If we went back in time to January of this year, who thought we were going to see the 10-year Treasury go from 2% to 4.5%, wherever it is today? Who would have thought that we would have a Russian invasion into the Ukraine? Who would have thought we had hyperinflation that's still with us? That's up 8-9%. No economist had these models. The Federal Reserve, with all of their 10,000 economists that work in the U.S. government, had these type of predictions, which I often show. I even said that in this slide right here, that the Fed is. This is just in June alone, the Fed thought that they'd be at 3.4% in the Fed funds rate. They're a whole percentage point higher. So if the PhDs don't know, I'm always in the I don't know camp. And I think I'm just always honest with you in that sense. And what I do is I say, okay, let's do scenario analysis. Scenario analysis, what this allows me to do is make, I think, more prudent decisions in looking in balancing your portfolios. Meaning, what if the worst case scenario happens? What if all the pundits who say the end is near, this time is different than every other time, we're never going to recover, we're all going to be shooting raccoons in our backyard, and we're heading into a deep, deep stagflationary type recession. And I never used to model I have to go back 20 years. I used to have 4 models. I'd have a bear case, a base case, a bull case, and a stagflation case. And I did away with the stagflation because we haven't had inflation for so long. Well, this bear case is now including stagflation, meaning if the worst case scenario happens, stocks lose another 15% on top of what we already lost. That's terrible. And I know that's not, the news you want to hear tonight. But I'm being honest with you. We haven't lost. We've lost 10%, but the stock market's lost 25%. And I'm here with the bad news to tell you is it's possible that we lose another, 15% or so on top of that for a 40% decline, which would be similar to the declines that we saw in, 1973, 1974, during the stock market collapse of 87, during the financial crisis that you and I went through, during the tech bubble that you and I went through in 2000. This is a really bad scenario, but it's possible. It's also possible that we have a Goldilocks scenario where the Fed threads the needle, is able to raise interest rates, stop inflation, we have a shallow recession, and the market's already discounted with this 25% loss, and we are off to the races, and stocks do wonderfully. U.S. stocks make 50%, international stocks make 55% over the next 5 years, and everybody's happy again. The truth is probably somewhere in the middle, where we have mid to low single-digit type returns for U.S. stocks. We're avoiding REITs because REITs look terrible to me. You see all these empty buildings in New York for a reason. The good news is with rates rising, I will finally, which I haven't been able to do for 13 years, buy municipal bonds again. When we can get rates up to close to 4% again, we've raised some cash and we may be buying municipal bonds again, which would be very nice for you to have something with more stability. It's tax-free, where I can get, and savers are now, we've opened cash accounts for a lot of you, where we're managing, because the banks are being pretty, the banks that we own, whether it's Bank of America or our international banks, they're not passing along those higher interest rates to you. They're kind of holding on to that cash. So what we're doing is buying short-term treasuries for our clients, because we can get you, that 3.5% return. And we do that, for free. We open up non-managed free cash accounts for you to manage our clients' cash accounts. If you've got 100,000 or more, we're happy to do that for you. And then high yield bonds. The good news about high yield bonds is we think that if we have a certain amount of defaults, even in a worst case scenario, is you're going to lose some money, but you won't lose that much, but it'll still be bad. But high yield bonds, the bonds that you and I own, we could see somewhere around right now, if we don't have any defaults, then we'll get about an 8.8% return. I don't think we're going to get that either, because I think we'll have some defaults. Some of the companies that we own, like a Bed Bath & Beyond, may go bankrupt on us, or some of the companies we own. Again, my best case estimate is we only have minimal defaults, and you get an almost 8% rate of return. Again, the truth is probably somewhere in the middle. So we have about 20% of your portfolio and my portfolio in high yield bonds, and we've gone equal weight for the first time in my 25-year career. We've gone equal weight between U.S. stocks at 35% and international stocks, because international stocks, again, look so cheap. To me, the downside risk is the same, and I'll talk a little bit about this later. The downside risks are effectively the same, even less, I think, for Europe than the U.S., but the upside potential is better. And that's for Nestle versus Hershey's. That's for GlaxoSmithKline versus Pfizer. That's for international banks like a BBVA versus a Bank of America. And that's for Total instead of Exxon. We own both, but I think we could see international stocks outperform U.S. stocks. And I'll kind of get to that a little bit later too. So that's what I do from an economic scenario analysis side, is kind of look at what the possibilities are and then position our portfolio for where the opportunities are. Because here's the problem. Inflation, I don't know if we're at peak inflation or not. I think we're getting close. If I had to guess, I'd say we're probably getting close. Sometimes the cure for inflation is inflation. When things get too expensive, then people stop buying them. You're kind of seeing that. I always look at housing. And to me, when you look at housing and you look at auto sales, those are two areas where you're already seeing, especially with higher rates, see how the house, it's come down significantly, right? The green line being home sales are coming down rapidly, and auto sales are probably starting to come down here to more normalized levels, because the cars are lasting so long, we probably don't need to buy new cars. I'm still driving, and my son drives the 2000 Land Cruiser here in New Jersey with approaching 300,000. It's in the shop actually for the last 2 weeks, but approaching 300,000 miles on that thing. It's doing great. So inflation probably going to be sticky. It's probably going to be a while for the Fed to break it, because it takes time, right? They have to. They have the blunt instrument. The good news is for economists is in a deflationary environment, the Fed can lower rates to zero and you and I tighten up, and only the government spends money in deflationary recessions. So it's the old Keynesian pushing on a string issue, that the Fed can throw all the money in the world into the middle of a pot, and you and I aren't going to borrow it. And secondly, businesses aren't going to going to borrow it either, because they want to hold on to their capital for the to make sure they have the cash to survive that recessionary period. Only government spend. But the other great period of time that we have is and many of you will remember this, the late 70s and early 80s, we had hyperinflation, and Paul Volcker raised interest rates very aggressively to break it. He actually subsequently took it down too quickly and then had to raise it back up to break it back in the 80s. And you can kind of see that right here. You see that, you can see the chart when we had that high inflation of the late 70s, early 80s. And economists, we have the two tools. And the two tools is raise interest rates, and that will break inflation. Eventually, it'll break. Now, it often comes with a recession, but remember, the 80s were quite good. Now, history often doesn't repeat itself, but it kind of rhymes, and every situation is different. The good news back at that period of time is we had Tip O'Neill and Reagan come to an agreement to lower taxes. We're not going to be lowering taxes right now. And so we have higher taxes right now, and we have a higher regulatory environment, which isn't great for business. And you have a lot of fighting between Democrats and Republicans on the energy front. So some of this is different right now. This situation is different than it was in the early 80s, but energy is not as big a component as it was also back in the 1973-74 energy crisis, when we had that inflation push up. Energy is not as big a component as it was back in the early 70s. So is this the break right here? Are we seeing goods coming down? We're starting to, but we still have to pay. In the financial services, in my industry, businesses are already starting to lay people off. The same thing with technology. We're seeing that, whether it's Microsoft or Elon Musk saying he's going to be laying off 75% of Twitter employees. But we still, unfortunately, we still have money and disposable income. We're still going out, and you got to pay that person who's making a burrito or cleaning a hotel room. You got to pay them a lot. Augustus, my son, last summer in Montana was making almost $30 an hour as a busboy. Maximus was making $15 an hour because he didn't want to work as hard as a busboy, just putting sleds on the mountain for people to kind of go down. So you really have to pay people a lot to get them back to work, especially when they have to go into work. It's not like all of our associates, for the most part, are all working from home, and the world has changed from that perspective. We were already, pre-COVID, we were already a virtual on the cloud firm. So COVID wasn't a big deal for us, but most firms now realize, wait a minute, we can do this cheaper. We can reduce our real estate exposure. And frankly, employees don't want to come in. Most people like working from home, and most people like their wives and husbands and children and dogs and want to continue to work from home. So that's been a permanent change in the economy that's here for good. So once it gets into wages, I thought inflation was I was team transitory early on. And I kept saying, and you saw this in the newsletters, until we saw it move into wages. Once it moved into wages, this was one of the jokes that I kind of was saying with one of Maximus's friends who works at the Chicago Fed. And I was screaming at him saying, tell Charlie Evans, who's the Fed governor of Chicago, I said, tell him to, stop with the quantitative easing. We're seeing it in inflation. What is he doing? So the Fed has made a horrific mistake by continuing to do quantitative easing and not raising rates when we were seeing inflation in the economy. So now they're behind the curve and having to raise interest rates aggressively to break inflation. But they are committed to that right now. And until we see, is this little downturn here? You kind of see it here. Is this little downturn right in here? Is that the beginning of inflation breaking? If I had to guess, I'd say yes. I think we'll see inflation come down. Now, we're not going to see it come back down to 2%, where the Fed wants it. I think we can get it down 4 or 5%. Now, the big question for the Fed is that enough for them to stop raising rates? And then the market can kind of get back to going again once it sees, the inflation start to break there. So that's my outlook on inflation, which I know, and I've been writing a lot about because I know that's the question that's most top of your mind right now. And so I keep focusing on companies that can pass along the higher cost of inflation. So if we look at a company like like Kraft or Procter and Gamble here, which you can see. And we looked at their, my son asked a great question a couple of years ago. He goes, Dad, how does Procter and Gamble pay a higher dividend if their stock price is down 20 or 30%? And I said, Maximus, that's a great question. And here, you look at Procter and Gamble, it's all about the earnings, right? So if Procter and Gamble, now I don't shave as much anymore, right? So I shaved yesterday. And so I'm not using as much Gillette razors. And what Procter & Gamble is seeing is people are trading down. Instead of using Tide, they're trading down to a cheaper brand. So they're starting to see that. The good news for Procter & Gamble and Pepsi and others is that they're not going to the generic brand yet. So people are trading down, but they're trading down other Procter & Gamble products. So even though Procter & Gamble, let's say in a horrific scenario where they're earning $5.81 a share, they're paying you and I $3.65. Well, let's say that in China they're using less Tide detergent and you and I are shaving less. Well, let's say their earnings get cut by a horrible 20%. Now, most analysts, that's unlikely to occur. But let's say that it does, right? Let's say it gets cut by $1.20. If it got cut by $1.20, and if Procter & Gamble is only earning $4.60 a share, they still have the money to pay you and I that $3.65 a share. So don't worry. Don't worry that, oh my God, Procter & Gamble or my portfolio is down 10%, 20%, 30%. Procter & Gamble has never cut their dividend. When you look at Procter & Gamble over the last, and let me show you this graphically. Procter & Gamble going all the way back to even as far as our software here will take you back in 2003. Look, they were paying 21 cents a share, and then they raised it, and then and they kept raising it, and then the financial crisis came, and the whole world blew up, and all of us were wondering, geez, are we going to all be shooting raccoons in our backyard? And the answer to Procter & Gamble was, well, we don't think so. Let's raise our dividend. They raised it from 35 cents to 40 cents during the financial crisis. And then COVID came along, and we were again wondering, is this the pandemic of all time? And what did Procter & Gamble do? Raise their dividend. They raised it from 72 cents to 75 cents. And they've continued to do that. So though you may worry about my fee going down because I'm getting paid 10% less when your portfolio goes down, don't worry about your income. Those green triangles I was showing you earlier, you're invested in 74 other companies, just like Procter & Gamble, that have not, reduced their dividend. Of those 74 stocks, I'm only worried about one right now, B&G Foods, to cut their dividend, because maybe we're eating less Green Giant and their earnings might get hit. But they're still going to pay about a 4% dividend, even if they cut their dividend. So those green triangles are going to be for you there during your retirement. So don't worry too much about the price of the stock in the short term, because you can get whipsawed. I mean, the market's doing that in the middle of a day where you wake up in the morning and the futures are down and then they go up and then they finish down again. You can't chase that. We're invested long term in these companies. So the real interest rate, because inflation is so high, is still negative. And the Fed's got to get this to zero, right? You can see what Paul Volcker did when we had negative real interest rate here. Paul Volcker raised interest rates to break inflation, and he broke it. And then we had, the Fed funds rate coming back down. And now again, of course, the Fed's got to keep raising rates to break inflation. But the Fed didn't know what they were doing. They really screwed this up. And they're catching up right now. So you can see their estimates. Again, for an economist, prognostications, they have no idea. Nobody has any idea. Don't listen to anybody on TV. When you hear some moron get on television that says, this is what the market's going to do, we got to go all the cash, or we got to do all this, they have no idea. And I know that too, because I'm selling to financial advisors, and financial advisors are some of the dumbest people on the planet when it comes to, thinking they know what the market's going to do. Nobody knew earlier this year. Nobody knows what's going to happen next year. That's part of the uncertainty. As a former Marine in wartime, we would call it the fog of war. It's the same thing with investing. You never have a green light or a red light that tells you what to do. You have to stay invested and hang in there long term. The bad thing is that during a rate hike cycle, right? The green line here shows that when the Fed's not raising rates, or the blue line when they're in a slow quarter point rate hiking cycle, stocks do well. Stocks do not do great, and they do go down, as you can see here in the months after hikes. Stocks do not do well, and they tend to be very flat. And again, this is why I think it's a stock picker's market, why the dividends matter to you, why you're getting a 4% dividend yield. And if you look at stocks, if you look at our whole portfolio right now, I mean, look how cheap our companies are. Normally, historically, you go back, the market's still overvalued because of those 5, 6 tech stocks that are still way overvalued. Our companies are selling at 8 times earnings, which is really cheap. Even if the E part, right? Even if the E part, the earnings part goes down, our companies are still from historical 100-year levels, very, very cheap right now. And they're paying you a big fat 4.5% dividend yield. These are our international stocks. And the same is true for our US stocks. If you look at our US stocks, selling at about a little bit more than international stocks, selling at about 9 times earnings with a little bit less dividend yield at 4.5. But still, Procter & Gamble is going to be there for you. Nestle is going to be there for you. And I think it's, important for you to know that this is, I think, I'm excited about stocks at this level when I look out 5 years. I know it's horribly painful to go through this type of sell-off, but I'm in the only business when everything's 25% off, nobody wants it. If it was a sale at Macy's, we'd all be out there getting that new suit for 25% off. But in my business, people want to buy high and they want to sell low, and I don't know why that is, but it's human nature when it comes to the stock market. So, oops, let me go back to the presentation here. So, the labor market is still very strong. That's not good for inflation because we still have 2 job openings for every 1 person who's looking for a job. That's, that means you got to pay people more to get them back to work. And that's the good news, right? Like, so when you're asking like, hey, how's this good and bad? Well, the good is that the bad is inflation. The good is that the labor market is strong, meaning when you have low unemployment rates, what that means is that the consumer is this. You can see the consumer's out there. He's doing very well. The American consumer is definitely losing steam, buying less cars, buying less homes, buying less stuff, but still buying. And his income is holding up there. The bad news or the neutral news is that Americans gone through his savings now, right? We were giving them money to sit at home, probably a bad idea to pay people to sit at home. Finally, we said, hey, we paid them once real big, we paid them twice real big, and finally we said, hey, we got to get people back to work. Let's stop doing that. That's inflationary. Now they're out of money, right? They're tapped out. So their savings is back down to almost historical low levels. So is this Christmas going to be a good one? I'm always a cautious optimist, and Zach was making fun of me the other day saying, every Christmas you say this Christmas is going to be the best. And I said, this Christmas, if I was a guesser, I don't think this Christmas is going to be the best. I think this Christmas will be okay. I think people still have a lot of pent-up spending. You look at the airline fees are very, very high. People are still going on trips. The good news is that they're working differently. They're taking off Mondays and Fridays. So they're going, at Altrius, we get off 30 days a year. And people are able to say, hey, let me just take off. And people are taking off earlier on those Fridays and they're going on trips. And so United and American and Delta are seeing that. So people are still out there spending money. They're just spending it a little bit differently. And that's a real positive. Again, they're spending less on homes and cars now. We're seeing that kind of come back down. That's not a bad thing. But corporate profits, as we're in the earnings season right now, are remaining very, very high. Companies, because they're able to lower their real estate, and they're not even getting there yet, right? Because their leases were 5-10 years out. Their leases are just coming due. And you're able to renegotiate those leases. And now where you had 100 people in those offices, at one time, now you only have 50. Because, Joe's saying, hey, I'm only going to come in Tuesdays and Thursdays into New York. I'm tired of commuting into the city an hour both ways. And, Sally's saying, I'm going to come in on Wednesdays and Fridays. And they're doing hot seats. So that's enabling companies also because their people can work from anywhere, just like us, where I've got, Zach's in Austin, Anu's in Connecticut. Max is in Savannah, Georgia. Chris is in Raleigh. Everybody's everywhere. And you can work from anywhere now. You can work from Mars if you're willing to work from on East Coast time. Anybody can work for Altrius. And that's a real benefit for corporations, because now you can live in Michigan for a third of the cost that it costs to live in New York. Or you can live in Raleigh, North Carolina, which is a third of the cost of living in New York. And that mass exodus out of the major cities is not going to end, especially with the crime that we see in the cities. I mean, going in to see Hannah, who works for Bloomberg in New York, having lunch with her, it's New York's back to a war zone. The way, not quite as bad as it was in the late 70s, early 80s, but pretty close. Some of the stuff that you see, unfortunately, going in on the train. Corrections, again, how far is this going to go down? I have no idea. The average is 30%. Sometimes it's a lot worse, right? You and I have been through the horrific downturn of 2000. We went through the horrific downturn, 50+% of 2007 together. We went through a horrible, COVID correction. We went through a 20% correction, which you probably only remember in 2011 because it was relatively fast recovery in 5 months. The financial crisis and the tech bubble were, lost decades almost, where those times went. COVID was a quick recovery. The market lost 34%. It was terrible, but we recovered very quickly before it started coming back when the unprecedented amount of government spending that we had. I have question marks here. How long is this going to go before the trough? We could be at it already. Or, as I mentioned earlier, if this is a stagflationary recession we're going into, we could be in for another 15%, and this could go down 40 or 50%, kind of like we had last time. And again, don't want to scare you. I just like during these periods of time when we had these horrible downturns, Procter & Gamble did not reduce their dividend. So your retirement is not likely to be impacted at all. Will you want to tighten up? Maybe. And you can see when we've had these corrections, usually they coincide with recessions. Not always. This was, 20% almost bear markets where it didn't coincide with recessions. COVID was a recession. This one, we're in a recession. We just don't want to declare it just quite yet, but we're probably already in a recession. If you 2 negative quarters of GDP, but the unemployment's still high, so economists may or may not declare the recession yet. We'll have to see when we look back on this thing. The other good news is that usually for those who hung in there, owning it and buying more stock, if you have cash, if you're brave enough to throw some more cash in right now, that usually pays off handsomely for you in the long term. And that's, in almost every case you can see, as long as you had a 5-year time horizon, stocks did terrifically well after terrible stock market corrections. Value, our style, again, is value. We haven't seen a bubble of growth versus value. I tell all my young, really everybody at our firm is young. And if you didn't live through 2000, back then the Amazon and Teslas of the day were Microsoft and Cisco and Intel, and they were selling at 100 times earnings and not paying a dividend, and that imploded. And value did very well for a 7-year period. But then we got back to zero interest rates, and then all of a sudden growth is just massively outperformed. But I think we're back to basics now, where valuation matters again. That's why we're massively outperforming. That's why our U.S. stocks have kept pace with the S&P 500 over the last 15 years, because these stocks have just imploded where, in June, you and I were flat on the year. But then we suffered through a correction in July. We had a rally in August and a horrific sell-off in September where the babies, our babies, the Procter & Gamble's and Nestle's were thrown out with the bathwater. People just said, I'm scared. I'm selling everything. I don't care how cheap it is, Jim. I don't care what a nice big fat dividend it has. I just want to sell and stop the pain. And I get that. But I think you're going to see value well outperform growth here for the next decade, as long as the Fed doesn't get stupid again and go to 0% interest rates, which is not healthy in my opinion. The same is true for international. The reason why for the first time since founding the company in 25 years, we're equally weighted U.S. and international stocks is these things are cyclical. And you can see international stocks outperform for a long period of time, and then U.S. stocks outperform. And U.S. has well outperformed now since 2014, international stocks. And I think you're going to see a reversion. And again, when I'm selling to institutions, they look at our portfolio and go, geez, Jim, you got a lot in Great Britain. Everything's terrible in Great Britain. Like, I don't care where the headquarters is. I don't care where the company's headquartered. it doesn't matter that GlaxoSmithKline or British American Tobacco is headquartered in Great Britain. It matters where they're selling to. It matters, in the US, are they going to still use GlaxoSmithKline drugs? Are they still going to smoke British American Tobacco? Are they still going to eat Nestle chocolate? In Latin America, in Asia, that matters much more than, when I sell to institutions, they're often hooked on the idea, and you can see that in our presentation. They'll ask, oh, Jim, we see that your international exposure, if you look at our strategies and look at just our international stocks, we see that you have a lot of Great Britain exposure. And I'm telling them, it doesn't matter where the headquarters is. I mean, you look at Europe developed and United Kingdom, you would think, geez, that's 78% of your portfolio. What matters is where they're selling to. Almost 30% is sold here in the United States, only 18% in the Eurozone. Only, and you can see Asia is a big chunk of the sales of those European companies. And that is much more impactful. United Kingdom's only 4%. So who cares if the prime minister just turned over and they put Boris back in or they put somebody else? What impact does that have on how much Nestle chocolate, like I say in my book, is consumed in Latin America, or how much Pepsi is consumed in India? None. And so, I'm always banging the table for institutions to not think in terms of where the company's headquarters. It doesn't matter where the headquarters is. It matters where the revenue is coming from. That's why I think there's as I showed you, our portfolio, international stocks are much cheaper than U.S. stocks right now. And the dollar has certainly been very strong, and that hurts us as U.S. investors because foreign currency has to be converted. It's likely that the dollar is probably going to stabilize, even though the whole world is in trouble, and here in the United States, it's not great, but we're the best looking, person in a room of ugly people with our interest rates now coming up. So it's, it could be, as I say here, the Fed becomes even more hawkish. That's supportive of the dollar. But eventually the Fed and people do worry about our debt, going back to here, and people say, can America keep affording to pay us back? If we lend them, money for 30 years, they've got a high debt rate. And I put in here, people often say, Jim, you sound, if they're a Democrat, they say I sound like a Republican. If they're a Republican, they say I sound like a Democrat. I always say I'm a Federalist, and my party died with Hamilton. Even my daughter Elena's middle name is Hamilton. I wanted her first name to be Hamilton, and thank God that play came out. And because they wanted to take Hamilton off the $10 bill, and just take Jackson off. He was a racist and a terrible economist. He closed the bank, and great general Jackson was. Our last populist president too, by the way, before Trump. And we had economic turmoil. It was terrible when Jackson closed the bank. I'm like, take Jackson off to 20, put somebody else on there, but don't take Hamilton off of currency. We owe so much to Hamilton. But both Democrats, you can see this. We had, here's in the 50s and 60s, it was, there aren't any Democrats left like Kennedy who lowered taxes. If you listen to Kennedy, Republicans have kind of gone further right and Democrats have gone further to the left. And there aren't many moderate Rockefeller Republicans left, and there aren't many Sam Nunn Democrats left anymore. And you can kind of see that during the Johnson and Kennedy administration. We actually lowered our debt. The Carter administration, nobody wants to go back to the Carter years where we had horrible inflation. We only had 30% debt to GDP then. And then, of course, under Reagan, we exploded the debt, to fight off the Soviet Empire, and that was good for the market. And then, we had Clinton and good market returns in there too, which kind of helped us lower. It's Clinton who actually lowered the deficit, because the Republicans and the Democrats both like spending money. And then after Clinton, of course, Bush increased the debt, in the Republican administration. Obama exploded the debt, to help us get through the financial crisis. And then Trump exploded it more, right? Because he's a real estate guy. He loves debt. So he just, boom, popped it up here. Now, the question mark is, we haven't been back here at this level since World War II. What's sustainable? Well, Japan's been at a lot more debt, to 200, 300% debt to GDP for much longer. Nobody worries about Japan. Maybe America doesn't have enough debt. We don't know because capitalism is a 300-year endeavor. It's just that we've had economies collapse at 30%, like Iceland and Ireland, and we've had plenty go on, like Japan, for much greater debt to GDP because it's really your tax base, right? And America has advantages that other countries don't have. We have innovation, intellectual capital, which we protect. We have vast resources of land, and we have, for the most part, a very free economic system. And that's advantages that really you can't find anywhere on the planet. I mean, Hong Kong was pure capitalism, and it exploded. Of course, now it's under China's rule, so it's not the same. But I don't worry about America, and even if it did implode, I don't worry about capitalism because capitalism will find an outlet somewhere. Nestle will just move, and Pepsi will just move its operation, much like a company like we have, like Eaton, which just said, "Hey, America, you're charging us too much in taxes. We're now an Irish company, or we're now a Swiss company." They could just move, especially when most of their revenue is coming from overseas, right? That's what companies are going to do. Just like you and I might do that. We're, New York, you're taxing us too much. We're going to move to Florida. California, you're taxing us too much. We're going to move to Montana. And you're seeing that here in the States too. So I wrote Is America Going in Debt? A blog 4 or 5 years ago. Is America going broke? And again, as a patriot, I worry about these things, but as a capitalist, as an investor, I don't. So what are we doing with our portfolios? Well, as I mentioned, we're effectively going neutral to U.S. stocks. I still don't think that safe bonds are a good investment yet, like municipal bonds or the cash accounts that we're managing for you. So we only have about 22% in high yield junk bonds. We have a little bit more in cash right now because I'm getting ready. Hopefully, if we see rates pop up again as the Fed raises another 0.75%, where I could buy you some municipal bonds in your non-IRA, non-retirement accounts. And we've got an equal weight between U.S. and international for the first time because, again, I think that international looks quite compelling. And again, where's the revenue coming from? Well, half of it's coming here in the United States, but half of it's coming from all around the world. And I think that's important to know that your revenue is very well diversified across the globe. And with that, again, your income is huge right now. We're getting about a 5.5% dividends and interest for your portfolio. And that's pretty darn good. That's a nice, compelling yield for you at a very cheap valuation compared to, of course, the broader market indices. And that's the same for our bond portfolio, our U.S. stocks compared to the S&P 500, or we've always gotten higher dividends for you. It's just where we focus on. Same thing for our international portfolio. So with that, I'm going to try to unmute everybody here if I'm able to do it. Where is that button? There's no button. I guess you can unmute yourself or send me a question in the chat. Let's see. Yeah, I think you can unmute yourself. Yeah, okay, go ahead. Guy, I think you've unmuted yourself. You have a question, Mr. Amy?
No, I was just unmuting.
Oh, okay, great. Does anybody have any questions for something I didn't? Hopefully I solved all the world's problems tonight, but maybe not. There's maybe some more questions out there still.
You got me, Jim?
Yes, sir. I hear you, Guy.
Hey, I just had one quick question in regards to the interview you had here this last week about the ETF fund. Could you explain that to me a little bit? Because I didn't really catch on to what was going on.
Yeah, so the ETF that we launched is not for you and I and or anybody on this call. The ETF is, we sell that to, you kind of see this picture here when we launched on the NASDAQ. That's sold to financial advisors and institutions that don't hire us directly to buy individual stocks and bonds like you and I own in our portfolios. So it is used. We are using it for some, like if you have a grandchild that only has $5,000 to invest, or like my kids are buying DivD, they're buying our stocks, because my son, he doesn't have $500,000 to invest in our individual stocks and bonds, but he does have, $600 that he can kind of throw into. And with DivD, what he's able to buy is the exact same stocks that you and I own, so that it's not even priced right now yet. You can see after today, and DivD is doing great, just like since we launched on September 30th. We're able to own these stocks. You'll see a price today. We're beating the S&P, and we're beating international stocks. You and I own the same stocks that are inside the Altrius dividend ETF, but we wouldn't put you in that because it would be unethical for me to do that, because we're charging you a fee, and then the ETF charges another 0.5% on top of that. It's 49 basis points. So we're not putting any of our private clients into the Altrius Global Dividend unless they have less amount and are invested in ETFs. Then we're putting them into our ETF, because for those clients, then they can own the same stocks that you and I own.
Okay, so with that being said, I understand better now. Does that pay us anything?
Yes, DivD will pay the same dividends that our client. It's a monthly dividend payout. So if somebody said, is my grandchild going to get the dividends? It's paying just like you and I. When Nestle pays you and I, and Procter & Gamble pays you and I in a particular month a dividend, it's also paying our ETF, and that's distributed to those financial advisors and investors who are in it, a monthly dividend. So it's the same, because it's the same stocks that are. But again, you and I, we're not going to be investing in it, because you have enough in assets to buy the individual stocks. So we don't. We only use this on our institute, which you'll kind of notice if you go to our website, you'll kind of see that it says, hey, if you're a private client, go to this website. If you're a financial advisor, go to this website. And financial advisors, they might want to just buy our international strategy, the international stocks you and I own. They might just want to buy our U.S. stocks. They might just want to buy our bonds. They might want to do everything. That's the global income. That's what you and I are invested in, all of the U.S., international, and bonds. Or to be easier, a lot of times advisors don't want to, when I'm selling to a financial advisor, they don't want to show the client, they could buy us through Schwab, but they don't want to show the client their fee and our fee. So they'll just say, hey, our clients won't see your fee. So they were clamoring for us to launch an ETF. They're like, Jim, we love your strategy. We love what you're doing there. We want to buy your strategy. So we launched an ETF so that financial advisors can, get the benefit of what we're doing for you with the ease of an ETF wrap.
Okay, so with any of those people buying into it, there's nothing that actually comes back to us that are already in with you.
No, you and I already get you and I already get those dividends from the stocks that we own.
Okay.
Yeah.
Thank you.
You'll notice if you go to our funds website, you'll notice that when you see the stocks, they're the same stocks that you and I own. When you look at the top holdings, it's Total, POSCO, BBVA, British Petroleum, Siemens. You and I own all of these stocks, right? AstraZeneca, Novartis, right down to if I went to all of the holdings here, B&G Foods, Hanes Brand Underwear, Intel, Bristol Myers, Pfizer. You and I own the same. These are the same stocks that you and I own, but this is just so that somebody with $5,000 can make the same and own the same stocks that you and I own.
Okay, thank you.
And that's what's a little bit different about Altrius is that, we're not like 98% of our competitors that are wealth managers. And most of wealth managers, they have the layers of fees. They have their fee, and then they chuck their clients in ETFs and mutual funds, which have a layer of fee. The difference between us is that you're getting an asset management firm and a wealth management firm. So you're getting, if you look at our people, you're getting the financial advisory team of our advisors but you're also, getting the investment team that's helping to manage your portfolio. The track record is obviously, mine for the past 20 years. The fixed income track record is now Zach's, who's taken it over the last 3 years. And he's done a fabulous job. He's been with me for over a decade, and we think the same. And I said, Zach, I want to keep focusing on the equity side. And I often say, if I get hit by a truck, I have full confidence that Zach can continue on and managing your money and my money, or my money for Annie and your money. Did I answer your question, Guy? I hope I did.
Yes, you did.
Okay, good. Thanks.
But if nobody, I got a follow up if you don't mind.
Yeah, go ahead.
With the upcoming elections, depending on what happens, do you see any major changes whatsoever in what the stock market might do?
Yeah, we're going to have gridlock, gridlock is very good for the stock market. So, the good news is that with the House is almost definitely, unless something weird happens here in the next 20 days, the House is absolutely going to go Republican. The Senate is a little bit interesting because the Democrats have an advantage in the states they're in, and Republicans, made the mistake in some states of kind of putting up candidates that may be too far right for those more moderate states. So the areas where Republicans might be able to pick up some states, they may wind up losing, like the Herschel Walker race with Warnock in Georgia, the Dr. Oz race in Pennsylvania, the Arizona race with Mark Kelly, the Nevada race, New Hampshire race. So the Democrats have a bit of an advantage going into this. So I suspect that the Senate's going to be very, very close to whether or not it flips Republican. Either way, though, the House is most likely going to flip Republican, and that makes Biden into a lame duck president. He won't be able to do anything else anymore. And that's very good for the stock market. The stock market will be very happy that we have gridlock, because then only major things will get done. So I think that the election should bode very well for the market, would be my prognostication for the elections. Regarding the presidential election 2 years from now, who the heck knows? I think, unfortunately, I think Trump will run again, and I don't think Biden will, because he doesn't seem, to be there, and the Democrats are most Democrats are even fed up with Biden at this point. So who knows who the Republicans and Democrats are going to put up 2 years from now? It seems to be an eternity, but in the short term, at least for the next 2 years, from a political standpoint, again, this probably has little impact. Even if this happened where we had all Democrat or all Republican control, it's not going to change the way that I invest. And oftentimes we make decisions on our investments based on politics, which is a big mistake in my opinion. But we do. I love politics. Senator Young is a friend of mine from Indiana. He tends to be sort of like Joe Manchin is in the Republic. He's the only one who came out against Trump who lived and didn't get primaried. And yet I'm friends with Cory Booker, even though I probably disagree with him 80% of the time. I think he's a decent man. And he and Todd get along. And usually it's the people you see on TV, the senators and politicians who are the knuckleheads. And there are some good people still in politics who are trying to do what's best for the country. So again, usually I'd say turn off the TV and don't listen to the politicians on TV, because there are some good politicians when you get in the room with them one-on-one. And I often have meetings with them. I had a bunch of meetings with them in the Harvard Club in New York, where I meet with a lot of Republican senators often. And some of them are quite knowledgeable and quite thoughtful about their, about the positions. And I think that's a good thing. You don't often see that on television, where you have left and right kind of selling ads and selling airtime rather than, doing what's best for the country. So I would say don't worry about the political side of it too much. And in most likely case, we'll have gridlock, which should be good for the market anyway.
Thank you.
Yeah, you bet. Good questions, Guy. Thanks. But do tell your kids and grandkids about our DIVD. You know, we're happy to. We're excited that it's a way for smaller investors to be able to invest with us. And if any of you are cheating on us with other advisors, tell your advisor about DIVD and how they should be investing in it, because most advisors have gotten just. I mean, Fisher Investments is down 30+% this year because they chase investment performance. They've just decimated their portfolios. I sent out that piece of us versus Fisher. It's truly apples and oranges. We're completely different birds. And, you know, we feel our way is obviously much more prudent way to invest than chasing performance. So that's, I've been pounding the table telling these advisors to invest with us for years, yet they say, oh, Jim, you're too boring for me. And, you know, your strategy, your process is too boring. Now they're all coming to us. Now they're all like, oh, yeah, you told me about that. And, you know, maybe I should have listened to you. And some of them are grounded at their high price too. And they're hoping that Tesla comes back. They're hoping that Bitcoin comes back. And like, why would you do that to your clients? You know, it's unfortunate that they did that. Any other questions? I'm happy to stay on as long as you want. I'm always working till at least midnight, even on a Friday night. You know, I always joke, if you email me on a Friday night at 11 o'clock, you get an email back, because I'm sitting right here in front of my computer, whether it's Michigan or here in New Jersey. And so feel free to bug me anytime. Bruce knows that, because Bruce, you email me often on the weekends, and you always get an email back. So. Any other good questions or bad questions?
Look forward to seeing you in December.
Yeah, me too. I'm sorry we had to. I'm looking forward to seeing you in December. Hopefully, we won't have any hurricanes in December, so we'll have I guess it's good that.
Hey, Jim, it looks like Mike has a question in the comments.
Oh, let me look in the chat room here. Are there any particular companies to keep an eye on during earnings to try to get a sense for upcoming economic trends? Yeah, Mike, I think that Pepsi and Procter & Gamble just this past week are great examples of the current trends, in that now it could fall off, but what you're seeing is that Pepsi and Procter & Gamble have been able to pass along the higher costs, and they're doing it in two ways. One, you're seeing is we get shrinkage, right? None of us should probably be eating Frito-Lay, and you can rename Pepsi Frito-Lay because half of their goods come from the snack food size. In fact, I wrote a note to the CEO of Pepsi when he was retired. I said, hey, thanks for taking care of our shareholders all these years. You know, we've owned Pepsi for so long. And he wrote me a note back. He goes, oh, New Bern, the home of Pepsi. And he's a Naval Academy grad from like 70 something. And it wasn't a mistake that Indra Nooyi, who is, you know, the CFO, became the CEO, because Pepsi saw the growth potential in India. And Indra Nooyi did a wonderful job of guiding Pepsi over the years for our investors and for you and I. And that's the same case right now. They're doing a very good job of mining their bottom line. And so we could start to see some cracks, and we're certainly seeing cracks in the tech company, right? The tech companies are starting to see some real cracks in earnings. I'm glad we're not invested in a lot of those crazy, what I call the clown companies, the companies that, you know, that just don't have any real earnings that are out there. You know, you look at a company like Splunk or SoFi or any of these kind of companies that are just ridiculously priced and continue to bleed earnings all over the place. You know, look at all the red, right? These companies are losing millions upon millions of dollars. Why would you invest in those companies? I have no idea. Now, the old growth way is, well, look at their top line revenue. They're just exploding. So we have to invest in them. And eventually, like Amazon, they'll become profitable. We don't invest in hope. I want to see real earnings. It's like Mr. Wonderful and Shark Tank, right? And when he says, what are your earnings? You know, what are your real sales? That a disciplined investor, that's what you want to do. So it's the same for us. We're seeing very good. That's, you know, a good question, Mike, about earnings. We're seeing currently, at least, we could have cracks, right? We could have people are eating less Nestle chocolate or eating less Pepsi, or, you know, we're seeing it some companies, especially like industrials, financials are doing well because as interest rates rise, they're able to make more profits on their capital reserves. And you and I aren't, we're leaving our assets there at Bank of America whereas we shouldn't, right? If they're not willing to pay us 3.5%, if you look at rates right now, that's what we're doing for our clients is we're buying you. You look at the yield curve, and we're buying you 1, 2, 3 month Treasury yields, and able to get you, as you can see here, 4%, 3.5% yields on your cash. Banks are not doing that. They're only paying out like 2. They've already passed on the higher costs of, because the mortgage rates go with the 10-year Treasury, which, as you can see, the 10-year Treasury has gone from 2% to 4%. So mortgage rates are already over 7%. They've passed along those higher costs, but they're not passing along the savings here. Competition hasn't gotten them to drive down. That's good for those companies because they have enough capital reserve where they don't need to pass it on to you as a savings account holder. And that's why we're opening savings accounts for you. So very positive earnings season so far. And fortunately, the companies that we own are holding up very, very well. Sometimes they give very cautious guidance going forward, like a Johnson & Johnson will say, hey, things are great right now. Earnings are good right now, but we're cautious going forward. So the stock price will go down in the short term. I would say the same for my company. I don't know what my company is going to do. I don't know what Altrius is going to do next year. I would say I'm cautious because we could have a correction. So I don't know if I'm going to make as much next year as we made last year. Or this year, we're down from where we were last year. It's always hard to make these prognostications. So, but I do know and do feel strongly over the next 5 years that earnings is going to normalize when we go through this recessionary period. That's what I feel pretty good about. That's why I like buying these companies at 8 to 9 times earnings. So for an economic trend, again, like I said earlier, Mike, there's 2 types of economists: those who think they know and the think they know camp, and those are that I'm in there are the I don't know camp. I'm not going to lie to you and say that's why we do that scenario analysis. Look at the worst case scenario, look at the best case scenario, and then our base case scenario, what we think is the most likely case scenario. So in the short term, your guess is as good as mine where what this is going to look like. I'm buoyed and constructive in the sense that it's been a better although there's lots of bad news out there, it looks pretty positive from what we're seeing so far during this earnings season. But that could change next earnings season. But again, I don't look at it over the next quarter. I'm looking at over a 5-year time period. Hope I answered your question. For those of you who can't unmute yourself, just throw something in the chat. I am seeing your typed in messages here. So. Any other questions out there? Nothing. All right, great. Well, thanks so much for joining me tonight on a Friday night. And my pleasure, Mike. My pleasure, John. And everybody else who joined us tonight. And if you have any other questions, as always, feel free to give us a ring or shoot me an email. And we're happy to answer your questions. And thank you for your continued confidence. I mean, I'm always humbled by the fact that you've entrusted us with your life savings, and that I don't take that lightly, which is why I'm always up late trying to position our portfolios to get you the best rate of return that we can and a prudent one, and get those dividends for you. So, thank you very much.
Thanks, Jim. Have a good